We move straight into our lender panel debate. So just by way of introduction to our esteemed panellists and our moderator today, we have Steve Griffiths, who is Sales and Product Director for the Mortgage Lender, Mark Hollands, Head of Sales and Distribution at Bluestone Mortgages, and Matt McCullough, who's National Sales Manager at Aldermore. They're going to be covering, the lender approach to self-employed, adverse credit and complex income. Obviously, the MPC's decision takes place 15 minutes into this session, so you never know whether opinion might change based on their decision. But to moderate the session, pleased to introduce Jane Benjamin, Director of Mortgages at Connect Mortgages. Jane, the floor is yours.
Thanks, Ian. Thanks. Hello, everybody. Welcome to our session on complex credit. To start the session, I'll just give you a bit of background. Pre-session, we went out and we had some questions put to us by fellow advisors in the industry and industry peers to give us a bit of a feel for the questions that we might get today. But we'll pause a little bit of a way through to take some questions from the floor as we go. So to start us off, yes, I was reading an article that hit the press in Solutions on Tuesday from Metro Bank that actually referred to there being 40 million customers in the UK who have a less than perfect credit history. And actually 81% of people with adverse credit think they can't get a mortgage. And lenders aren't interested or can't help. And actually, I thought that was quite shocking, and I thought it was quite sad, especially as an industry and a group. We all try and work collaboratively to make sure that we find a solution for every customer. So let's start off by sort of talking about perception and versus reality, really. So I guess my first question is, with the impact of the pandemic on customers' accounts, with lenders, has that provided a challenge for lenders? And are we in danger of leaving customers behind? What can lenders and advisors do to help those customers?
I think it's good. Bad news always travels fast, isn't it? I think it's always the bad news that you get in these kind of situations, and I do think as an industry we probably need to do more to actually show some of the solutions that are out there for those type of customers. Certainly, it's very much a hot topic at the moment. Obviously, we're very much into self-employed, sort of changing of actual proof of documentation with the tax deadline, self-assessment deadline just passing. So we're now in a period, probably for this year, probably for a big chunk of next year as well, where there's a good chance that if you've got a self-employed applicant, you're going to be looking at a document that has some impact from that COVID period, from sort of April 20 to 21, where maybe some businesses were closed, maybe they had increased costs, they had a slowdown in their business, and that's had a knock-on effect into their profit. And I think certainly there is a danger that there can be a perception of that. If you're one of those customers, then that's it. There's nothing you can do. And there actually is. That's kind of what specialist lending is for. Certainly self-employed is the cornerstone of specialist lending. If you look at the market, sort of the labour market, about 15% of the labour market is self-employed. I had a look at our stats for January. Our residential self-employed percentage was just over 50%. So that kind of just shows you that gap between what the average employed market is versus what a specialist lender does. I don't know, similarly probably stats from the guys here as well. And that 50% number is probably up around about 10 or 11% since we introduced our COVID impacted criteria sort of back in the summer, early autumn. Generally, there are three types of customers. You've either got a reduced income because they had a COVID impact and they're now back to normal and they're trading, but their accounts don't reflect that. There's quite a simple solution to that. It's just effectively just ignore the COVID impacted accounts, and if you're able to, lend off the previous year's figures. There are lenders that will do that, and absolutely that's something that we see a lot of that type of business in. There's customers that aren't quite back up to their 2019 figures, but they're probably earning enough to borrow what they want to for their purchase or remortgage. So again, just looking at maybe a projection of, using their costs from their pre-COVID account, using a projection of what their income is now from their current trading statements, not that complicated to actually justify using a number to support their affordability. So both of those customers, there are solutions for. And then you kind of get customers that the accounts actually look okay, but they've had some government assistance. They've had bounce back loans, grants, furlough, etc. And that's just about taking a pragmatic approach to say, do you know what? That's life. That happened. Businesses took that, arguably quite a prudent approach to take some of that support. And as long as you can see that they're not relying on that support now, then why wouldn't you lend to them? Again, it's not in everybody's risk appetite. Not every lender will want to do it, but certainly I think there's enough lenders in the market that can support those kind of issues with customers.
Okay, thoughts, guys?
Yeah, I think for me, certainly the industry needs to do better to signpost that there are solutions available for those customers that are underserved by the high street. We've got our own PR agency that have done some research for us as well, and we found that I think 2 in 5 customers that had the ability to get a mortgage that had been turned down by the high street decided not to progress with the mortgage application, even though they had the financial capacity to do so. One of the things that I find, and I have found really refreshing over the past few months, I think COVID, obviously the pandemic had a huge impact on everybody's lives, and I think even as specialist lenders, it took us, a period of time to get to grips with that. And I think we kind of got to around the summer of last year. I think things began to sort of settle down a little bit. We'd come off that massive sugar rush of the stamp duty deadline, and then it was almost like, I don't know if any of you like Formula One, but it almost feels like we're in a bit of a development race at the moment to get to the end, and we're all kind of working with each other and fighting against each other to bring out new propositional developments to help people that are underserved by the market. And Steve's mentioned what we do with self-employed people and COVID bounce back loans, and that was something that we introduced to the market early last year as well. And there's just so much more that we're all doing, and it could be quite frustrating at times when I look at the press, oh no, TML are doing this and Pepper are doing that, but the fundamental thing is all good for the customer at the end of the day, that we're working together to provide solutions for those customers that are turned down by the high street.
Okay, and Matt, with regards to sort of spikes in business as a reaction to things that lenders are doing, what are your thoughts around that?
Yeah, so in terms of I'll cover that question on both sides really, because first and foremost, the spike in business for a lot of people that have done really well out of the back of the pandemic, because there's a lot of them customers as well. And I think we need to remember that lenders need to get probably more flexible with how they approach self-employed now moving forward. The guys have mentioned there that someone could have had a really good year previously and actually had a dip during COVID. It could be the opposite. So, and for me, I'm a big believer of history tells a great story in some circumstances, but it never tells you reality. Today does. And I think there's a really big area in this market for specialist lenders in particular to start looking at the reality rather than history. And actually, if someone's had a great year, just look at now. And if it's continuing, then move forward, make it far easier for that self-employed borrower. What that then does, though, is cause what we've seen is quite a lot of spikes in business for where the larger lenders may have turned away the self-employed borrowers during this period. So it's great that we could come in and support, but we haven't got the infrastructure to support that. So service hasn't always been prime and hasn't always been as quick as it should be. But at the end of the day, we have to remember that we're getting the customer what they're looking for. If that's a short-term solution before they maybe go back up to the high street, great. But I think it is affecting lenders having these spikes of self-employed customers come through because, unfortunately, they find it challenging on the high street still.
Yeah, I guess, and as far as a broker community, it's how do we reach the customers that don't know that they can get a mortgage and that they don't understand about specialist lenders. So I guess that's one of the challenges. And then managing the expectations around service and deliverables. But I mean, we work with 155 lenders in the market, and I know we're just a snapshot here, but it's very rarely that you can find a solution, can't find a solution for a customer with some circumstance. So, yeah, we just got to work harder as a community and find a way to reach those customers, I think.
And I think we're in a good place at the moment because, and I use this in the best way possible, but there is nearly a home for every single mortgage inquiry that you're faced with, really. Yes, it can be a bit more challenging to place it, and there's some more caveats and documentation, but there's a home for nearly every mortgage customer out there. And depending on the circumstances, how quick they need the finance, if it's the remortgage versus the purchase, what's happening, it can dictate whether they wait or they move. But for me, now's never been a greater time to like link into the client bank. And actually, it's about how you position that to your customers, because, you know, if you go through that up front and manage them steps at the start in terms of, right, you know, you may not be a ex-high street customer, but here's what we're going to do for the first few years to get you on that cycle, to get you that mortgage repayment history, and to get you in that brand. We can look to do something else in the next few years versus, sorry, I can't help you right now, which unfortunately the research and the surveys are showing that's what's happening because they're getting blockers elsewhere. It'll take a bit longer, but honestly, there's some great lenders in the market that are willing to help near enough every customer out there.
And that sounds to me like a massive opportunity for advisors. So out of something that looks a bit dark, actually, it could be great. And I guess the other bit that we've then got coming down the track is a rise in energy costs. And that could then see some even more customers going into credit impaired. Have you thought about that? Any thoughts around that?
Yeah, I mean, massively. I think, you know, we as an industry need to, you know, work together to look at what trends are impacting on business at the moment. I mean, I'm very much hypothesizing here, but, you know, one of the things we've done at Bluestone is constantly look at the challenges that are being faced. We've got a great team of BDMs and key account managers that go out there and get that feedback from the broker community about why they're struggling to place cases. So, you know, a lot of lenders will have different lending criteria around CCJs and defaults, for example, in terms of what they ignore, what they don't ignore. And who knows, maybe this time next year we're talking about a situation where lenders might start ignoring energy defaults for less than £1,000. It's all about listening to, you know, what's happening in the market. I think I heard a news article this morning that said that energy costs are about to go up by, I think, £600 a year. So absolutely, we are going to, you know, the effects of the pandemic are still washing through. But more importantly than that, we've got rising energy costs, rising inflation. I think in April, taxes are going up to help support the NHS and social care. So the best thing that, you know, the broker community can do is really educate themselves on what solutions are available and feed that back into us so we can adapt our lending criteria and our propositions to help develop, to help support that.
Yeah, energy bills and defaults are really interesting because we see a lot of those. We actually have that step now where if it's a utility bill, we don't treat it as adverse up to a CCJ point, so sort of payment profiles, defaults, etc. And that can seem pretty punchy, but actually when you look at most of the circumstances, and we see a lot of those cases, there are lots of people with energy supplier defaults. They default very quickly. You don't get sort of 4, 5, 6 months in arrears that you might do on a store card or something like that before you get a notice of default. It can come within sort of two or 3 months. And actually what we generally find is they're probably not under financial pressure elsewhere. It might be that they may be going through some financial restructuring, and that the advice they're being given is actually maybe you've got in a bit of a mess here and you've not paid your mobile phone bill and you've got into a bit of a mess and we've got a default on your gas supplier. But actually there is underlying affordability if we can take your mortgage off a variable rate, if we can sort out some of these higher cost credit cards, etc. So actually you being part of that solution again is a great opportunity because we will see more of that. There is more squeeze on people's finances, and just that extra bit of fine tuning that they can do, I think will focus more on what are they actually paying out on their credit. And it could be that alarm bell of getting a default on their credit because they've got into a bit of a situation on their rising energy bill, could be the trigger that actually, puts them back on the straight and narrow. Because that's quite often what we see. They're not generally habitual, sort of non-payers of credit. They're kind of blips, which is generally what most credit cases are. But in particular, energy defaults, we see that.
Yeah, and that's what we do really as an industry. We create relationships for life out of helping customers. So it's more than just that one case, it's about long term. And to give everybody in the room a little bit of comfort, there are even more solutions coming down the track. Lenders have got to achieve targets this year. not just specialist lenders, but mainstream lenders as well. And actually, lenders are prepared to take more of a risk now than they were before COVID. So looking at different circumstances that customers are facing at the moment, and actually, is this an area that we can help in or we could go into to get a bit more business? So it will help them with their targets, but it's always a balance between risk versus sales. But as a broker business, which my business is, we are speaking to more lenders about different areas of the market that have gaps that our business and advisors need support in for customers. So it's coming, and I feel really optimistic that actually we're in a new space now with regards to solutions for the market, and our advice community is actually being seen for the professional community that it is, which is awesome. So, but I'm going to shut up and ask, has anybody got any questions before I carry on with a couple more? Okay, at the back over there.
Can I just ask, are funders still in the mentality of looking at P60s as a gross income and lending against that, as opposed to self-employed directors who earn X amount as a salary to avoid the 40% tax bracket and then take a dividend at the end? Do the underwriters actually understand accounting?
Thank you. That was a harsh question. Right, who wants to take that first, gents?
I'll take that one. Because I've got a great answer. No, it's a really good challenge actually, and my ears must have been burned because we were talking about actually how we need to upskill lender staff to perhaps talk a bit more competently about accounting and how it's presented, because I sort of manage our telephone BDM team up in Glasgow. We get about 250, 300 calls a day, and there's some really challenging calls on there about kind of how an accountant has maybe presented a set of figures. To answer your question, I think it depends on the lender, and I think this is where advisors hopefully can get a bit close to specialist lenders and see who's their go-to lender maybe for that scenario, because all lenders have a slightly different criteria. So for us, we do take that approach. We'll say, okay, if you're a P60 employed person, we're going to take your gross income off your P60. That's what goes into the affordability calculator. If you're a limited company director of that business, i.e. that guy's boss, then we'll take your salary and we'll take your share of your pre-tax profit before tax. So effectively the same thing. That's what we think is the equivalent of a limited company director's P60 earnings. It's salary plus share of profit before tax. But other lenders might do it slightly different, but they might give a bigger income multiple. It's very much horses for courses, but certainly I think you'll find there will be lenders that will take that approach. We certainly do.
Yeah, and just on that, just that lender point. So we do something similar, but we do it after tax, but we do it with a higher LTI. And the point Steve made is you find a home for that, but when you've got the home, you know the scenario. If it's pre-tax you want, great. If it's more LTI you want, then it might be the post-tax route for the risk. I think the key thing to remember is that whilst all lenders across the country, not just us, want to educate underwriters to know situations inside out, the difficult thing they have to do is underwrite to their policies every day that unfortunately over this past 18 months have changed quite a lot. So we have to remember that whilst there's a massive journey, I'll take this from an Aldermore point of view, to not just educate, my staff in the field, but the underwriters internally to the finer details of actually how a case is made up. We need to remember that these policies also have been so flexible that they're probably still getting their heads around that, to be fair.
Okay. Yep. Thank you. Any more questions? Oh, we've got another one.
No, I haven't finished yet.
No, sorry.
Because you still haven't answered the question. When you look at the gross income on a P60, that's the figure you take to lend. However, anybody that's got a P60, pay slips, etc., only looks at the bottom right-hand corner because they've got no control over national insurance or tax, subject to all their earnings. From an underwriting perspective, my question was, if I've got a client who's got 30 grand as a company director, but takes a £70,000 dividend, and that still happens now, even in the pandemic, why isn't his income £100,000 if he wants to borrow 300,000 or 400,000?
Yeah, sorry, if I didn't answer it clearly, Absolutely, we'd take that approach. In fact, we'd take more than the dividend because we'd take pre-tax profit.
Yep.
So you've got that, your dividend's obviously going to be off the net profit.
Yeah.
So we'll take pre-tax profit, which will be a bigger number than perhaps what you're referring to there. So again, not every lender would do that, but we certainly would take that approach.
Okay. The other comment that was made was that 50% of people are now self-employed, and that's going to increase because we're all going to live longer, simple as that, and the employment ratio is going to be less people working and putting into the pot, so to speak. So my question on that is, whilst we've got later life lending, equity release and all of those sort of things, some of those people are actually in a situation where they can now get mortgages where 20 years ago they couldn't. And I understand the risk versus reward from an underwriter's perspective, because he's got his MD kicking him in the backside, saying lend the money because we need to make the profit. And we've got the other people turning around and saying, if you lend that money and it goes wonky, it's your job on the line. So somewhere there's got to be a balance and a bit more flexibility.
Yeah, I think you're right. I mean, I think everybody's sort of looking at the balance of risk versus reward, and it's probably something that you'll see maybe sort of balance out as we go. But yeah, we'll perhaps pick up with you afterwards on that as well, if that's okay, for a bit of a chat.
Yeah.
Okay, guys. Okay. Any other questions before I move on? No? Okay, right. So, a couple of questions that were put to us before. So, we were talking about brokers who potentially sometimes have complex credit cases and are a little bit nervous. They think it's really difficult or tricky. So how can we as an industry sort of help dispel the myth?
Okay.
Go.
Yeah, I think at the end of the day, it's just a mortgage. Specialist lenders, and certainly lenders like Bluestone, where we are dealing with customers that usually have had some form of financial difficulty in the past. So we do clearly have to do a little bit more due diligence. It's not a case of it's past credit score, send in a latest bank statement or latest pay slip, computer valuation, and voila, you get your offer. It's not quite that simple, unfortunately. So there are a few things that we're looking for when assessing a mortgage application that has complex credit. So the first one is typically the life event that's happened that's caused that customer to get into some form of financial difficulty. We're not here to help out somebody that just doesn't pay their bills because they forget. We want to know that there's a good reason why they've got into some form of trouble in the past. We're here to help good people that have had just a bad time. And typically that revolves around divorce, loss of income, or loss of job, or loss of income perhaps due to COVID impact, or even health issues are quite common. So that's the first thing that we're looking at. And then you've got bank statement conduct, which is vitally important. I've been a broker before, and I'm not going to lie, there's probably a few occasions where I just threw the bank statement at the lender and literally had no comeback whatsoever. But we will look at those bank statements, and we will look at them in detail, and we're looking for certain things. So we're looking for signs that the applicant is no longer in any form of financial difficulty. So can we spot payday loans, things like that. We're looking quite detailed into their affordability as well, make sure that we're comfortable they can afford the loan. We're looking at and investigating any kind of large transactions that we don't know what they are. And we're also looking for signs they may have other accounts, because we want to see the latest bank statement from all accounts, not just the main one that they have, so that they're not hiding something. So I think if you get into that mindset of just making sure that you look through the bank statements in a little bit more detail, you'll find that those cases will come in and they'll go through a lot quicker and a lot smoother. I mean, what we've done recently is we did used to ask for 3 months bank statements. For PAYE customers, we now only ask for 1. We did some research into that, and we found that about 90% of occasions where we asked for 3 months bank statements, if we only asked for 1, we'd have come up with exactly the same customer outcome. So it gave us the confidence to say, right, we don't need 3 months bank statements anymore, we just need 1 month. And the other thing that we're looking for as well is the recency of adverse, which is really, really important. So at Bluestone, we don't like CCJs or defaults that have been registered within the last 6 months. No mortgage or rent arrears in the last year. That's really, really important, because you'd think that when people are in financial difficulty, the thing they want to protect their most is the home over their head. So we want to see that they're going as far as they can to make sure that their mortgage or rent is paid. And the final thing, again, I've mentioned this already, is no payday loans within the last 12 months. That's something we're quite passionate about, because obviously if they've taken a payday loan in the last 12 months, that does show signs of financial stress. But the one thing that's unique, certainly about Bluestone, a little bit of a kind of a shameless plug here, I guess, is we're one of the few lenders, I think probably the only lender, that work with the applicant's credit profile based on the date of completion, not application. Now, that has 3 benefits for your customers. And this is something that sourcing systems don't really show up when you're putting the case details in. So the first benefit is it enables you to apply now. So if you had an applicant who had a CCJ that was registered 3 months ago, and we say nothing in the last 6, that's based on completion. So you can get that application underway with Bluestone now. The second thing that gives you is the ability to potentially move the customer into a higher loan-to-value bracket, because that adverse credit has become more historic on the date of completion, and also gives you the ability to get a better loan as well. Sometimes just by delaying completion and moving the applicant into one credit tier to another can actually save up to 1% in interest on that loan. A £100,000 loan over 2 years, that's £2,000. It's a lot of money. So yeah, that's, I think, probably 4 key tips from me in terms of when you get those complex credit borrowers, things to look out for that are really, really important from a lender perspective.
So, and I guess it's really important to know your BDM or your point of contact, because brokers, it's impossible to know every lender's criteria. It's just too much. And I know there's tech that helps with that.
Yeah, absolutely.
But there's nothing better than being able to have a contact and a conversation about a specific. So, I guess probably make the most of any training or development or CPD opportunities that you can, really, to sort of refresh your mind. So I know I can't remember everything.
I think one tip I would give is to go on to TML, our website, Aldermore, and just the first thing to familiarise yourself with is the credit tiers. The rest of it is all just criteria, but understanding the credit tiers and where your customer fits within those credit tiers is the most important thing. I've been a broker before, and I've shied away from submitting this kind of application because I don't truly understand it. I actually realise now that if I spent 1 day just looking at lenders' credit tiers, I actually would be in a much better place, and I think that's just really, really important. And the rest of it is all just criteria around how you treat self-employed and contractors.
I was thinking about this yesterday as well, in terms of what makes a complex credit customer. It's really just the lender that you end up placing it with. The customer's the same. So if you get approached by a customer that maybe has been declined by their bank, and why is that? Or I've got a bit of a problem on my credit score, I've missed a couple of credit card payments. And the first thing you probably do is do a cheeky dip with the Halifax, and it passes. They're not a complex credit customer, are they? Great. Now, they might have a low score and a low pass, so they might want a manual underwrite, and they might want to ask for some bank statements, and probably do the kind of same thing that Mark's just said that we would do. Probably isn't that different. They'll get a cheaper rate. They might get a higher LTV. They may get both. You get that customer's friend who comes to you for the same scenario, but actually the missed payments are a bit more recent, or maybe they tripped into a default or something like that, and the cheeky dip with the Halifax fails, then all of a sudden they're a complex customer. It's the same customer. It isn't actually that different, and actually, dependent on where they fall in those credit tiers, some of those scenarios, which is the vast majority of the market, I can tell you, 90% of the market is people that have minor credit impairments. They're in the near prime. Multiple CCJs, big bankruptcies, IVAs. Yes, there's lenders in the market that we will all do that type of business, but it's very much in the minority. Most of it is people who've missed a few payments, they've got some historic adverse, they're probably borderline between whether they pass a Halifax dip or you're over the line into us. But if they're just over the line into our world, the rates probably start with a 2, not necessarily a 4 or 5. They won't start with a 1. And from that customer's sort of journey on their mortgage, it's not a million miles away. So I think that's the thing to remember. The customer's always the same. It's where it lands in terms of who can progress that, and it actually isn't massively, massively different. Most of it is just off the high street.
Okay. And just on that, just don't be scared by that word complex, because I know that I steal Jamie's line here from this morning when he presented on Glenhawk, but don't forget that your complex is like our normal, really. And how you deem a complex customer could be completely bread and butter to us. And the one thing I would say is that, like Mark alluded to before, is that the life events is something we need to know about. And all I would say is when you place in this case, just tell the lender the story. Be upfront and tell them what's happened, because if underwriters have to ask, they're looking to mitigate risk. If you tell them up front, they don't need to worry about that and they can move on with the case quicker. So always do that at the start.
That's great. Thanks, gents. And I just wanted to ask one question that's a little bit of a curveball. Can you explain to the delegates and talk to us a little bit about IR35, please? I know it's a bit of a strange one, but I was asked by a couple of folks about that.
I'll kick that.
Do you want to go with that?
I can go.
Okay, so yeah, the IR35 role, basically contractor mortgages used to be quite simple. You had a day rate contractor that was maybe an IT consultant or compliance consultant or whatever that might be. They'd be on a day rate, they'd have a limited company, and generally lenders that had a criteria, you know, kind of, again, Halifax kind of invented this about 10, 12 years ago. Clydesdale and some of the specialist lenders got into that as well. Your kind of day rate times 5 times 48 is that customer's income, regardless of the fact that they maybe have had a limited company that may have dividends, etc., that are structured behind that. And the IR35 rule came in and said, you can't do that anymore, because if you're working for somebody, you're working for somebody, and there was perhaps some shenanigans going on with actually how much tax and national insurance, unfortunately, some people were paying in that sector. So a lot of those customers have been forced now to go through different channels. So typically an umbrella company where the end client, has that kind of middleman company, and they pay out on that day rate, but deduct national insurance contributions, etc., but maybe in a more tax beneficial way for the end customer. Or it could just be a short-term, fixed-term contract where it's PAYE. If you've got a good contractor policy, you can still work off that day rate. So the income that goes into the affordability calculator, regardless of what's going underneath that, whether that is they've been under an umbrella company for one contractor for 6 months, they then maybe did a short-term PAYE, maybe they did manage to get something out of scope of IR35 and it went back through the limited company. We're kind of used to seeing that now. It can look really complex and really a little bit scary. It isn't. It is they're still that very much hybrid between employed and self-employed customers. There's a lot more of them these days. There's a lot of people that can demand a lot of money if they've got expertise in a field, and they will earn a lot more money on short-term day rate contracts than they would do going to work for a bank, for instance, on an annual salary. There's more of those customers. I think there'll be probably even more going forward. Don't be scared of them. It looks a lot more complex than it is, and certainly lots of specialist lenders can help out with those.
Yeah, I think this came across my path back in the summer. A very good friend of mine was a day rate contractor, and his employer was forcing him onto a PAYE fixed term contract with them, and they was actually trying to bully him into signing some form of contract to say that if they get caught out, he would be the one that faces the financial penalty, not the employer, because actually with IR35, the burden is on the employer. They will get fined if they are found to have somebody on a fixed-term contract that should really be taxed and insured at source. But it also goes one step further as well. I think not just IR35. If you look at just moving back to the pandemic, you've also got a number of people that have lost their jobs because of COVID, and they need to support their families. And so what would you do in that situation? You would try and find work any way that you can, and you therefore might want to take a PAYE fixed-term contract. And when you do that and you haven't got much contract or any contracting experience, there's not many lenders out there to support you with that. And actually, so again, going back to what I said to you guys earlier about that feedback from those kind of themes that you're finding from customers that are underserved, we need to know what they are so we can provide solutions there. We launched a new contracting update in January, whereby for a PAYE fixed-term contractor, we can essentially lend on day one, as long as they've got 6 months experience in that sector. So it's all about product innovation from all of us here to try and make sure that there's solutions available for everybody out there. Moving to Matt's point earlier, there typically is a solution for every customer. You just need to know how to find it.
Okay, thank you. Right, any questions from the floor before I fire one last one at these guys? Okay, at the back there. Thank you.
With credit impaired clients, I'm finding that they've become heavily impaired. I've got a client at the moment who was put into an IVA and advised to go into an IVA for £5,500. What can we do to the financial institutions when a client gets into difficulty to actually get them to give the client the right advice as to where they should be going to get debt management?
Good question. So I'll start on that if you don't mind. A good friend of mine's a broker and has a really big opinion on this. So a lot of her lead source comes from clients with adverse, mainly debt management plans. And one of the things that she's taken it on herself, do her own campaign. But there is unfortunately been, let me put it out there, like incorrect advice given from the IVA's position. People are being put into IVAs for the wrong reasons. It should have been a general arrangement, maybe even a DMP that's obviously not a contractual payment. An IVA, as we know, bounds that person for at least 5 years. And then, as we know, yes, we've got adverse lenders that will look for that specialism, but you've still got to wait 12, maybe another 2 years to get out of that position. So I think that people need to do more to potentially regulate that area and make sure people are getting the right advice for the debt, not just to, dare I use the phrase, bung it in an IVA and hope for the best. It needs to be a proper structured plan with the creditors to ensure that it's being looked after and they're not locked out of finance, because I think that's what happens. An IVA is easily sought after, but you're locked out of options for a long time.
Yeah, I agree, and I think brokers, it's not your area to give that level of advice, but what you can do if you know that you've got a customer that's considering that is to help them understand what the financial implications will be for them, certainly from a mortgage perspective. You know, if they have a mortgage at the moment, or they're thinking of buying a property in the next few years, because it certainly will have a big impact.
Okay, does that answer your question, sir?
What I always find is that it's already happened when they come to me to try and get their mortgage advice. And usually it's when they've got into difficulty with a high street bank or something, and they give them a telephone number, or you want to ring these people who might be able to help you with your debts and things. And like you say, it's not explained to them properly what they should be doing. And is there something that we can do in the market to make this more aware to the FCA to look to regulate it more?
I think the whole thing comes...
You're playing with people's lives and making them even more vulnerable than they are at the moment.
I should probably know this, but I don't know actually who regulates insolvency practitioners. It's not the FCA, is it? I think it might be the Ministry of Justice. I think it might be DOJ. It's a really interesting one, because you do see some really sharp practice when you look at that and think, how did that customer end up in an IVA? It's a good question. It's one I haven't got an answer for, I'm afraid. But
I think one of the challenges that we've got as an industry is it's got to go right back to education. And I sort of say this, and I have for years, about what kids are taught at school. You know, it's got to go right back. I mean, what do you actually need to know? It should be part of the curriculum about financial well-being and financial awareness. Don't know when it's going to come. I don't know if it'll ever come. I'm fed up of talking about it. But I think if people perhaps understood the implications of what happens with credit through their life and for their bigger financial purchases, then it would be a different matter. But I think it is the Ministry of Finance and Justice. Anyway.
And I agree with that, by the way. So it's the start. It's the education, because I don't think anyone in this room will remember the first contractual financial agreement they took out. I certainly can't. I don't think anyone will. If it's taught right at the start, you will, because you know about what happens if you go into payment difficulties, where you should speak to, where you should go. Unfortunately, you don't, and these people end up going to that place where it's a maybe last resort, they get the wrong advice, and then they are locked out of finance for a long period of time. It needs education to start in the schools for that, for me.
It doesn't really answer your question or help with a solution today, but we know as an industry that there's a problem. Yes, but okay, right. I've got the lights flashing at me saying I've gone 3 minutes over. So, last question. Top tip for our delegates, please.
And for me, tell the story. If it's got adverse, just tell us why, what's happened, paint the picture at the start rather than wait for the questions later.
Thank you.
I think educate yourself as best as possible with what we do as lenders, and also look at the market ahead. I think it's going to be remortgage heavy next year. There's still lack of supply issues in the housing market, so debt consolidation, remos could be quite a big thing.
I'll just channel my inner underwriter and ask you to, you get your checklist when you submit the case. We do a lot of conversations around, can you place the case with us? It's worth another quick call, maybe to a telephone BDM. Once you've pushed the button, get all your documents in on day one. You'll get a much quicker underwrite rather than maybe a drip feed. Upload your bog standard documents, your pay slips, your bank statements, the DDM, all that boring stuff. Get it in day one. You'll get a much smoother ride in getting your case offered.
Thank you. And mine as an advisor is, what a great bunch of advisors we are, and actually thank goodness for advisors in our industry. So let's just sort of try and do what we can, hold our heads up high and help all these customers, because I see it as a massive opportunity for the advisor community. So execution only? Really? Nah. So yeah, okay, I'll wrap up there, I think. Thanks guys. Thank you everyone.
Thank you.